is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you were just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? Psychiatrists haven't worked so far. I've never seen them running in. The psychological psychiatry fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go?
Peter Lynch, he's one of the smartest investors of all time, and this just gives you a glimpse into his genius investing mindset. And I do want to explain what Peter Lynch is getting at for those who didn't quite grasp it. You see, all investors, at some point in their life, they have to deal with a falling stock. I'm sure you've had to go through it. I've certainly gone through my fair share of drops. And These drops offer two very important questions. The first one is, should we sell? The second one is, should we buy more stock? So I want to explain in a bit more detail the answer to these questions as per Peter Lynch's video. And we'll start with an analogy. Let's say I come to you and I ask you if you want to play a game of chess. We'll say the loser has to give the winner $10,000. Now, would you take this deal if you've never played chess before? Of course you wouldn't, because you don't understand the game, and odds are you're gonna lose. However, if you're Magnus Carlsen, the #1 chess player in the world, of course you'd take this deal, because you understand the game and you know you're good at it. It's the same with investing. You need to understand the stocks and their underlying businesses before you buy anything. And importantly, you need to be good at this. If you lack the understanding, odds are you're going to be the dummy who ends up losing their money. I want to give you two modern day examples of smart investing when a stock goes down and dumb investing. So let's take Apple stock for instance. Earlier this year, they had a big crash. They went down in terms of price by 31%, almost a third of their market value wiped out. Now, people during this time were panicking. How much further is the stock going to go down? Should I sell? What should I do? But it was those investors who actually understood the value of the business who didn't panic at all and bought more. As you can see, earlier on in 2020, after the crash, Apple was in my recommended list of stocks to buy. You can go and view that video, because at the end of the day, Apple was still a solid business with a strong business model. iPhones were being used throughout the world, the MacBooks, the iPads, the watches, the iTunes, the services segments, they were still going strong. It was those that understood the fundamentals of the business who knew what to do and bought more. So that's an example of wise buying when a stock goes down, buying more when a quality business goes below their intrinsic value. But we can look at other examples that were not the smartest of buys. Let's look at General Electric. Halfway through 2016, it was selling for $32 a share and everything looked rosy. And then it started to drop and drop some more. At the start of 2018, it had dropped by half the original amount to $16 a share. This left investors with burning questions. Hang on, isn't General Electric a complete bargain right now? Because it's dropped by 50% and once it was selling for $32 a share. It must be a buy. And this is the exact thing that Peter Lynch warns about. Don't simply buy a stock because it's dropped by a dramatic amount in price. If you do this purely because of that fact, most likely you're going to lose. Now, that's why Warren Buffett says, just looking at the price is not investing. At the end of the day, you need to be buying a quality business, one in which you understand the mechanics of, and also where you got a decent idea of where the value is. You need to be able to judge whether it's a falling knife or a gem that's on sale. So I want to finish this video with some practical tips on how to tell if it's a falling knife or an absolute bargain. Because the thing is, these massive price drops often offer huge opportunities. You just need to be able to distinguish the good from the bad. So step 1 is familiarize yourself with the business and the business model. How do they earn money? Has this been hindered in any way recently? In the future, what is it likely to do? Are earnings going to increase, stabilize, decrease? And to be able to know this, you need to know the business well, like a business owner would. Step 2 is do some digging in the balance sheet. So you can do this simply through a website like Yahoo Finance and look at things like how much debt do they have. For example, Delta Airlines stock has a massive pile of debt, as you can see here. And another thing I'd look at is price to book value. This is what Peter Lynch was talking about with Kaiser Industries stock back in the day. If their price is ever cheaper than their book value, you've got a bargain on your hands. So have a look and see if the price to book is ever below 1, then you may want to consider buying. So those are just a couple of simple things that you can do to determine if a stock is a falling knife or a bargain gem. Because at the end of the day, these massive price decreases often offer major opportunity, but you need to be able to distinguish if it's an opportunity to become rich or broke.